If you want to get more food, just get up, please eat this pizza so it doesn't go to waste. And then at the end, if you have any questions, we'll all be available to talk to you, chat with you, answer any questions that you might have. So, thanks. Yeah, thank you. So, this is Chris Bush, and he's president of Elevate My Scores. And Chris and I have known each other and done business together for about the last 7 years. And Chris is, I've seen him evolve in the process, and he's very organized and very responsive. And, you know, of course, we don't want to refer to someone unless they are the way that we are. Accessible, available, responsive. So Chris meets all of that criteria. And he's helped a lot of my friends, and he's helped a lot of my clients. So it's someone that I like, know, and trust, which is also really important, especially when you're talking about your credit. So you want to make sure that you have somebody that's reputable and somebody that comes with a personal referral. So thanks for coming tonight. Chris is just going to cover a lot of the basics about credit reports and how they work, and just how credit reporting works in general. It's super interesting. I learn something every time I listen to him. So enjoy.
All right.
Thanks,
Debbie. Well, welcome, guys. I'm glad you guys came out here and on this rainy, muggy day. So what I wanted to kind of talk to you about, first off, my name is Chris Bush. I am president Elevate My Scores. I've been in the credit repair business for a decade. I've helped thousands of people get qualified for home loans over the years. But the thing I really want to talk to you about today is just kind of focus on, somewhat of a high level about credit, but I really want to impress upon you guys the most important things for home buyers that you need to understand about credit. So I wouldn't call this a credit repair seminar. More, this is a credit education seminar, so you guys can learn about credit and the most important things to know and take away from this, as well as answer any questions that you guys have that are credit questions. But don't be offended if we start kind of getting bogged down into some details. We can always take those offline. I'll just ask you to take them offline. But if you have some general credit questions, I can certainly get those answered for you guys here tonight. I know I have a couple clients in the room, so it's exciting. I don't always get to meet face-to-face with my clients. I talk to on the phone, so it's good. There we go. So let's talk about what's in a credit score. And now, first off, how many people look at their phones to find out what their credit score is? Yeah, a lot of people. Okay. What apps do you guys use for that? Credit Karma. Okay. Anybody use the app that comes with their credit card or anything like that? I know Capital One, Discover offers a credit score, and it is a lot of times I think Capital One and Discover both are FICO scores, and we'll talk about FICO in a second. But Credit Karma is probably the most popular that people look at. Okay. Now, how many people have looked at their Credit Karma scores and then have had their credit report pulled by a mortgage loan officer after the fact? Anyone? What's your name?
Jaguar O'Neill.
I'm sorry?
Jaguar O'Neill.
Jaguar, okay. So Jaguar, was your score on Credit Karma higher or lower than your mortgage report?
Higher.
It was higher. How much? Just a ballpark.
Maybe about 5.
5 points? Okay, that's it's usually more like 40 or 50 points higher than a mortgage score, and people get confused. Okay, now how many people have gone and bought a car and their score was different when they bought a car than what Credit Karma told them? Nobody, but you have. So it's because there are multiple ways to compute a credit score. All right. Now, how many people can tell me how many bureaus are used? 3. That's right. So actually there's 4, but there's 3 that we really only care about. Okay. Experian, TransUnion, and Equifax. All right. So a lot of the time people say, well, how many credit scores are there? They'll say there's 3. Well, there's really not 3. Okay. Now, how many people think that if you call Experian today and say, what's my credit score, that they'll give you an answer? They won't. They'll just say, go to our website and buy our credit score. Because they also sell a credit score. But guess what? Their credit score is not going to be the same as what Debbie pulls. Okay, it's also not going to be the same as what Covert Chevrolet is going to pull. All right, it's all going to be different credit scores. So that's why right here we say over 100 different ways to compute a credit score. All right. Now, lending decisions are primarily scored using what's called FICO. Now, I don't expect anybody to know this. Maybe Debbie knows it, maybe James, because he's sat in my presentation before. But how many people, or who can tell me what FICO stands for?
I guess financial for F.
Yeah, you'd be wrong, but Fair Isaac Corporation. Okay. So Fair Isaac Corporation, they basically invented credit scoring back in the 60s. They said, okay, let's come up with a number that we can sell to lenders. They can look at that number and say, is this person worthy of, this loan or not? Now, the mortgage industry really didn't adopt credit scores until the 80s. FICO has always been that method that was used. But it's not the only method. Okay? Now, FICO, for all lending, I would say 90% of lending decisions uses a FICO-driven credit score. That means when you go buy a car, they're going to use a FICO score. Now, you may hear them, or if anybody ever worked in the car business before? No. So sometimes you may hear the term beacon score thrown around. Beacon score is just it's a derivative of a FICO score. Okay? But that's what's used in the car industry. Okay? But it's all still FICO. So now when you go to, like I mentioned before, Discover shows you a FICO credit score. But how many people think that's the same one that Debbie pulls? It's not. In fact, if you go to a website called myfico.com, M-Y-F-I-C-O, myfico.com, they'll actually show you the, 20-something different credit scores across all the different industries, and you can see all of your different credit scores across all the different industries. But if you look at the mortgage scores, it's still not going to be the same as what Debbie and James would pull. And that's because when Debbie and James pull a credit report, they're using a mortgage FICO algorithm that is proprietary to them, to the mortgage industry. You're not going to find it on the internet. But there are other mortgage algorithms that are not proprietary, and that's what you see on myfico.com. Okay? So there's 49 different FICO algorithms. That means 49 different ways to compute a FICO algorithm. So next time you go and you have your credit report pulled and it's not the same as what's on your phone, don't freak out. Don't say, someone's lying to me. No, that's not the case. It's just that there's a lot of different ways to come up with the same answer. And the main industries where these scores are calculated: home, auto, insurance, credit card, and then finally the internet. Now, how many people have gone to move into an apartment or get into a rental home and they pulled your credit? Happens? Yeah. Yeah. They're primarily using like a mortgage FICO score, from what I've seen, just talking to the leasing agents that I've met with. And a lot of times that you need to have a 600 or even a 620 just to get into the home or to get into the apartment. Now let's talk real quick about the internet. So that is one thing I want to talk about. So when you go out there on the internet and you look for a credit score, Credit Karma, for example, and the internet credit scores, it really is the Wild West, but it's kind of, I would say it's calmed down, just like the West has, like here in Texas, it was kind of crazy one time. Now it's not, things are calm, right? But the internet was like that with credit scoring. There were just all these different algorithms out there. People just making up their own algorithms, throwing it out there just to sell a number. But now it's kind of come down to where there's what's called Vantage. Has anyone ever heard that term, Vantage? Now that I say it, next time you hear one of those commercials, you'll see the word, or you'll hear Vantage with a V. And even Vantage itself has gone through some modifications. And now Vantage has tried to be close to FICO, but it's still about 40 or 50 points off. Debbie, is that usually what you see with people that come in with their credit scores with Credit Karma? It's about 40 or 50 points off. Yeah. It's still off, even though it uses the same range as what FICO does. Now FICO and Vantage both go from a 300 to an 850. Okay. But that is, I would say, not FICO, mortgage FICO. Sorry, let me clarify that. But Vantage goes from a 300 to an 850. A mortgage score goes from a 300 to an 850. But there are actually derivatives of FICO scores that can go higher, like in the auto industry, it can go up to a 900. So, like I talked to a client recently, he was like, yeah, my credit score is an 860. And I'm like, wait. And then he clarifies, like, yeah, when I went to a car dealership and had it pulled. And an 860 at a car dealership is pretty darn good. That's, you know, almost, it's probably about the equivalent of like an 820 or 830 in the mortgage FICO world. Any questions about algorithms, or did I just blow you guys' minds and you don't have any questions? Okay, so let's talk a little bit about the mortgage FICO scoring model a little bit, because I know you're here to buy a home. So I kind of wanted to talk, you know, high level a little bit about the different sections in the mortgage FICO scoring model. The first one is your payment history. You know, all the payments that you make every month, your auto loan, your student loan, your credit card payments, any kind of loans that you're making payments on, mortgage loans included, all get calculated into payment history. Okay? So that means the more payments you make on a loan, the more it's going to help your credit score over time. And you're like, okay, well, yeah, age. And but that's actually age of a credit history or a credit item is more down here. This is actually the number of payments that you're making. But it also encompasses the negative items that are on the credit report. So anytime you have a negative item, collections, you know, bankruptcies, tax liens, judgments, late payments, all of that negative information also gets compiled into that payment section. Okay? But we're going to talk about negative stuff. We'll come back to that a little bit later on. So let's talk about next amounts owed. Okay, 30% of your credit score. Now, amounts owed, when you see that, you just think it's anything you owe money on, right? But it's really only about one thing. Okay, revolving. How many people have heard the term revolving before? Right? What is revolving?
You never pay it off.
But specific, I'm looking for a term. What's revolving?
Open accounts?
Open accounts. It could be open.
Recurring?
What I'm looking for is credit cards. Credit cards. So, revolving account is a credit card. So, and there's two different types of accounts: revolving and installment. All right. So revolving, you got to think of it like a revolving door. You know, you go to those big bank buildings down in downtown Austin, they got the revolving door, and sometimes you get stuck in them, and you're like, hey, when can I get out, right? And it's kind of like that with credit cards, right? Like, I'm stuck in paying this credit card, like you were saying. It's like, when do I get out, right? But that's what a revolving door and revolving credit line is. So if you open up a revolving credit line or a credit card, for $1,000, you go buy a $900 set of tires, and you pay it off, we can go borrow it again, right? You can go down and say, hey, I paid it off. I'm going to go to Fry's. I'm going to go buy me a $900 TV, right? And you pay that off. You use it again, right? So you continually use it. Now, when you buy a car for $30,000 and you pay it down to, say, $10,000, can you go back to the car dealership and say, hey, I want to buy another car on that same line of credit? No, they're going to pull a whole new loan and go through the whole process if you're going to buy a new car. Okay, they're not going to say, hey, you've got $20,000 available on that first line. They're not going to do that. Okay, that's an installment loan. Okay, that means you have fixed payments every month for a specific term, and when you get done paying it off, you've completed that account. Revolving can stay open forever. Okay, so revolving can actually one day score higher than a mortgage loan, because you could have had it for 40, 50 years. You know, the best credit score I've ever seen was a gentleman that had an American Express card opened up in 1963 and a Shell gas card opened up in 1967, and a home that he bought in the 80s. Okay, and that was all that he had on his credit card. But those two credit cards were much older than the home that he bought. Okay, so if you have a revolving line like a credit card, it can stay open forever. Okay, it's the one only line of credit that really doesn't close. Okay, if you decide to keep it open. And that's where I bring that up because some people say, well, should I close these credit cards down? Or sometimes people will make decisions, even emotional decisions like, oh, these SOBs, screwed me over. I'm closing this card down because of whatever, Or I used to fly United Airlines. I had United, Airlines card. They treated me bad. I'm going to close their credit card down. And it happens to be a card you've had open for 25 years. Okay, great. Well, you just screwed your credit score.
Yeah.
Okay. So that's the difference between installment and revolving. This section here, amounts owed, is just revolving. So that means if you do not have a credit card, you're only scoring in 70% of the model. Okay. Since we have pizza here, I always like to use my pizza analogy. So Domino's comes up and they deliver you a pizza and 2 slices are missing. You're going to be like, hey, what's going on? Right? You're going to be like, send it back. Okay? I don't have this whole pizza. Well, it's the same thing. If you do not have a credit card, you're only scoring in 70% of the model. You don't have a full pizza. So that's why it's so important to get a credit card for that reason.
Is it better if you have 2 or 3?
Great question. Great question. Because yes, we recommend having 2 to 3 credit cards. Now, that said,
what if you don't use them? Then, like you said, you get mad at somebody.
Yeah.
And say, I'm not using that card again.
Yeah. So if you stop using a card, it could actually dissipate the amount of a positive effect it has on your score the older it gets. So we always recommend to use it every once in a while. Even if you just have like Netflix or some kind of, thing you just want to throw on there, just to show activity. I know like I have a card that I don't really use. I threw our Sirius account on there for our radio and it just comes out, and I just pay it off, right? And I'm showing activity month after month on that card. So even if you have a card like that you don't really like, just throw something on there that you're going to spend on a monthly basis anyways, like membership type fee. That's a good strategy for that. Now, so you said, oh yeah, 2 to 3 credit cards. The point that I was going to make about that is, but don't say like, okay, I've had a card for 15 years and that's the only card I have. I guess I need to go open 2 more and that's going to help my credit score. And then you're going to find out your credit score drops and you're going to come back to me and you'll be like, well, that Chris guy doesn't know what he's talking about. So you do have to be careful about that. So if you're starting from scratch, go get 2 to 3 cards. Okay? But if you have 1 or 2, don't think you just need to go out and open up another one. Call me and I'll talk to you about it, whether it makes sense to do that or not. Usually when I'm looking at it and a client has had one for like maybe a year, then I'll recommend, opening up a couple more. But if a client has one, like I had one just recently, that they had 1 credit card and it was opened up in 2007. And I'm like, well, that's 11 years old. Let's not have you open up any more credit cards, even though technically speaking, having a couple more would help in certain sections, but it would hurt you. And we'll talk about length of credit history in a second. But it can hurt you in another section. So there's different pieces where all these different trade lines score. And a trade line has to do with the exact item of credit. Like if you have a Discover credit card and it's reporting on there to 3 bureaus, that's what's called a trade line. Okay, so that item, trade line, if you will, if it's older, you don't necessarily want to open up anymore because you can hurt yourself. Okay, but let's talk about for those people that don't have credit cards. Now you don't have to raise your hands or anything like that if you don't have a credit card. That's fine. But if you don't, just keep in mind that you're hurting yourself from a score perspective. But you're probably asking in your questions like, well, I came here because maybe my credit's not so great. So how do I get a credit card, Chris, if I don't have good credit? You're crazy. But there are credit cards that you can get even though if you have bad credit, okay? And it's called a secured credit card. Anybody heard that term before? Mm-hmm. Secured credit card? Okay. So secured credit card is you're going to take a little bit of your money, put it down into a savings account, and then open up a credit card against that money that's on there, okay? Now that, it's not like a prepaid card, okay? Because I know Walmart, you can go get a prepaid card, put a couple $100 on it, pay it off, and then you can close it down or whatever. And I actually had a client that she had a charge off on her credit report because she opened up a secured credit card for $200, and when she spent the $200, she threw it in the trash. Well, what happened is they charged there, annual fee and all that kind of stuff, and then it blew up into a big, huge, hairy mess. She's like, well, Chris, I thought that, it was like a prepaid card and I just threw it away. And I'm like, no, it was a secured card and it was reported on your credit report. That security deposit is just securing your line of credit. Just kind of like when you move into an apartment, what do? You give them a security deposit, right? Mm-hmm. Does that security deposit pay your rent? Mm-hmm. No, it doesn't, right? It's the same thing with a secured credit card, okay? It doesn't, make your payments for you. So if you open up a secured credit card for $200, you're gonna have a $200 line of credit. They're gonna hold on to that money until you close it down. When you close it down, you get the money back, okay? But it is a good way for those people that have lower credit scores to actually go out and start building their credit. Now on our website and places that I recommend, I actually do recommend some specific cards to our clients. The one that I probably recommend the most is Open Sky for people that are trying to get a secured credit card, because they do not pull a credit report. Okay, so that means it's pretty much a guaranteed approval, and it's only $200 to a security deposit. Whereas if you go to your bank, people are like, well, I'm just going to go to my bank or my credit union, and then they find out like their credit score is so bad they actually get turned down, and that happens. Capital One will turn you down. Wells Fargo will turn you down. Now, Capital One actually has a fairly decent secured credit card, but you need like probably a 550, 560 FICO to qualify for it, and there's some other factors they look at, but you can get turned down for a Capital One secured credit card, but it's still a good secured credit card. The one thing I do like about Capital One, though, is if you apply online for a regular credit card and they turn you down, they'll actually then kind of suggest that you go ahead and get the secured credit card, and you don't have to go through another whole inquiry. But with the Open Sky, they don't pull credit, right? So what does that mean? There's no inquiry. We'll talk about inquiries later on, but I'm sure you guys probably know that an inquiry can be bad, okay? So that's why I tell people like, oh, I'm just gonna go to my bank. I'm like, well, let's hold off before you go to your bank, and I know you probably like them, you know the teller's name by heart, whatever, but it may not be the best circumstance for you. Question?
Does Open Sky have annual fees?
They do. It's like a $39 annual fee, but that's not bad. Most secured cards are going to have that, and some secured credit cards actually charge you monthly fees, like $5 a month. So it's actually pretty good. And the interest rate isn't that bad. It's like 17.9%. I mean, it's not horrible. But the way I actually tell people to manage their cards once they have them is to use them very sparingly. Like, once a month, like what we just kind of talked about, show some activity on it. Go get you a tank of gas, some groceries. Don't spend more than like $30 or $40, and then pay it off. Okay, but I actually tell people leave a small balance on there, like $5, because it actually scores slightly higher if you have a small balance on there than when it's zero. Okay.
Does it hurt your credit if you apply for this? If you've got good credit, you apply for one of those
secured credit cards? Yeah, you would need to. So yeah, probably it would not be good for you.
That'd be a good idea.
Yeah, you don't. If you have good credit, you definitely don't need to get a secured credit card. It makes no sense, because you can go get what's called an unsecured credit card. Unsecured means you don't need to give them money. They trust you. They're like, oh, okay, you got good credit. Here's $10,000 security line.
So you just mentioned to leave a small balance on that card. That's kind of the rule in general, right?
Yes. Yeah, for any card.
But don't you have to pay a finance charge on it?
Yeah, for $5. I think over the course of a year, if you charge say $50 and then you pay it off, but leave $5 on there, you're only paying the finance charges on the $5, and then $5 over the course of a year. With 17% of that, I mean, it's less than it's definitely less than a Starbucks, but it's going to help your credit score. I mean, if you can just give up one Starbucks, a month that you're getting, and that means you get an extra 10 points on your credit score, you might do it.
So it doesn't hurt, or does it hurt you to pay it off every month, your credit card?
It's not that it's hurting you. It's a small little quirk in the algorithm that whenever you pay it down to zero, it's not going to be quite as high as if you leave a small balance on there. And a lot of times when Debbie runs and James, when they run what are called credit expert analysis, it'll tell them like to pay down to X, and it never tells them to pay it down to zero. And that's because it's calculating in that algorithm the difference between paying it down to zero and leaving, say, $15. In fact, sometimes they'll get some goofy number of like pay it down to $37 or something, right?
So it's not a good idea to pay it off completely every month.
Well, I mean, I would just leave a small balance.
Okay.
Yeah, but it's also, you know, some people ask me these kind of questions and they have like an 815 credit score, and they're asking me these kind of questions. I'm like, yeah, pay it off over the zero. Who cares?
Yeah.
You have an 815 credit score. But if you have like a 560 credit score, and those extra 6 or 7 points is the difference between you getting in a home loan or not. Or even if you have like an average credit score and you could be a 715, but if you just did something a little bit different, the difference between a 715 and a 720 is what, from a percentage perspective on your rate if you're doing conventional?
Okay, again.
So if you're like a 715 to 720, I mean, what is that as far as rate on a conventional?
Well, incidentally, on a lot of rate scoring models, that 720 is actually a threshold where there
Yep.
is an improvement, but so just incidentally, there might be like not even an 8. I mean,
Yeah, but there's a difference, right?
there is a difference.
Yeah, there's a difference between the credit score you get between a 715 and a 720, and that's the point I was trying to make. So even just doing those little bitty things can make a difference, you know. So the other thing I wanted to talk about in revolving about credit cards is for those people that have credit cards, okay? Well, how does it score when you have a credit card? Well, it's based off of the percentage of utilization. So let's go back to that example that we talked about before of $1,000 credit card and you buy a $900 set of tires. What percentage is that? 90%, right? Yeah. So that means you're utilizing 90% of that card. Okay. Now there's all sorts of myths, and I think most people understand that if your card is maxed out, that's bad. But I think there are some people out there that still believe that you have to use your credit cards and max them out and then pay them off and do these kind of crazy things. But it's all based off of the utilization of the credit card, and it has everything to do with when they report. So that means the credit card companies will only report once a month, and whatever that percentage is when they report it, that's what's going to be on your credit report. Even though, like I just talked to a client about this, I think yesterday, where I looked at it and said, well, yeah, I pay it off though, Chris, and it's actually the balance right now is $5. I'm like, well, yeah, but it's showing you have a credit limit of $300 and it's showing a balance of $295. So that means you're pretty much almost just maxed out on that card, even though you paid it. And when you look at their credit report, it said that it reported on the 6th, but even though you went and paid it off on the 10th, it doesn't matter. They're not going to be like, Capital One's not going to say, oh, well, I'm just going to go ahead and re-report this item just because you made a payment. They're not going to do that. They report once a month, and that's when they report. And whatever it happens to be at that particular time, that's what's going to get reported. Okay? So, but back to the percentages. Now, if you do have a credit card that's at 90% utilization, that means you're actually losing 90% of the points that you could potentially be earning towards your credit score. Okay? Let me just give you a little example of how that works. Now, this is theoretical. I want you to think that every credit card gives you 100 points, but I'm just using nice big round numbers. Okay. So let's just say a credit card gives you 100 points. That means if you have a credit card at 90% utilization, you're losing 90% of the points. How many points is that credit card earning you now? 10 points, right? Okay. Now, if you take that same credit card and pay it down to 30%, at 30% utilization, you only lose 10% of the points. But there's a little bit of a break there, right? It's not the same as the actual utilization. So at 30%, you're losing 10% of the points. Now how much is that card earning you? 90 points, right? So, so just by paying it down, so even if you have a credit card that's maxed out and it's at $300 and you have $300 on there and you pay it down to the 30%, that 30% threshold, you can gain a lot of points in your credit score. Okay, so these are the kind of things that we talk to our clients about as far as what's the specific percentage that you should have on your credit cards in order to help maximize your credit score. And it's the same logic that we use to go through this when we do what we call credit coaching. Okay, so let's talk about length of credit history. This is going to be an average of your open and active accounts, both your installment and revolving. In order to maximize this section, you would need 25 years of average credit history. So quite a long time. Anybody here think they have 25 years of average credit history? Debbie does. Stop bragging. But going back to this scenario I told you about, the guy who had the best credit score I've ever seen, who was actually the father of a loan officer from Marble Falls. But he definitely had 25 years of average credit history, okay? But do you have to have 25 years of average credit history to have a good credit score? No. Okay. But it's just to understand that this is an average. Now let's go back and talk about what we talked about credit cards. When she asked the question of, what's the good number of credit cards to have? 2 or 3, credit cards is what I said. But if you have one that's, let's say it's 10 years old, and that's the only line of credit you have, and it's 10 years old, and you open up a second one, and it's now that credit history is 0, what's your average? 5 years. So then what happened? Your credit history just cut in half because you opened up a new line of credit. Okay? So when people ask you, like, hey, Chris, is it going to hurt me when I have to go buy this car? I'm like, well, let's talk about that, because that's a bigger question than just, because people will say, hey, I got in a wreck, I need to go buy a new car. Is that going to hurt my credit score? Yeah, it is. But how do you get to work? Well, I can't get to work unless I have a car. Well, guess what? Life happens. You have to do what life tells you to do, okay? But, and I'm sure, the mortgage people will tell you, you're getting excited and everything's going well, and all of a sudden, I don't really like my F-250 anymore. I'm going to go get me a King Ranch F-350, And then you stroll up to your closing in that F-350, and you're like, hey, ready to sign the paperwork. They'll be like, hey, it's in the truck. Where'd you get that? And, they're probably going to be like, well, we're not going to close your loan because you just got a new car. So there are a lot of things that can, buying a car can hurt you. And in the mortgage people, I just remember that was actually a real story that somebody told me, a loan officer, and the loan officer told me, I hope you like sleeping in your new F-350 because you're not getting this house. But buying a new vehicle like that can hurt your credit score, but it can do a lot of other things too, as far as buying, when you buy new things. Debbie, if you want to talk about that real quick, what happens when you buy things?
This happened to me like a month ago. Some really good friends of mine were buying a second home, and they went and bought a boat, and it showed up right before closing when we did, because we had to do a recall right before closing to make sure nothing's changed, and it showed up, and it was a very large payment. So I asked her about it. She said, Debbie, I told you we bought a boat. I said, I thought you were talking about like a canoe. I didn't know it was an offshore fishing boat. They had to pay it off before we could close the loan. So it messes up your debt to income ratio.
Yeah.
So they were out of balance. It was too much debt, not enough income, and that was the one thing that threw them off.
Yeah, for sure. So
what about store credit cards?
Store credit cards? Yeah.
Does that hurt you as like the national cards, or?
We'll talk about store credit cards specifically and types of credit used. Okay. But yes, they can, kind of be a little bit of a detriment.
Going back to what you were talking about, it can hurt you if you get a big purchase. How big of a purchase are we talking about?
It really doesn't matter about a big purchase. It could be any purchase because from the credit score perspective, length of credit history, anytime you open up any account, I don't care if it's just $1,000, float loan or whatever you want to call it, could lower your credit score because it lowers your average credit history. But going back to the debt to income ratio calculations, they take those monthly payments that you have on there and they calculate into something that's called debt to income ratio. And they calculate all this, so even small loans could throw you off. Because if you're 1 percentage point different on a ratio, and it may not keep you from getting the loan, but it could actually keep you from getting into a different loan product, right, Debbie? It could kick you out. It could, but it could also just affect your loan in general, your interest rate and all sorts of crazy things. So
I always tell people, even if you've been pre-approved and you're under contract, do not go buy a refrigerator or furniture or anything until you have the keys in your hand and it's funded. So
yes, exactly.
a lot of times those debt to income ratios are just really tight, is how we refer to it in the industry, which means that it might be a max allowable 50% debt to income ratio. You might get 49.
Yeah.
So that one thing that tips you over the balance.
Exactly. You could be 1 percentage point away. So, and then with average credit history, there actually is a way to lengthen your credit history. We kind of talked about the negative part, but there actually is a way to lengthen it. Okay. Now, let's just say, I'll use this is actually my sister right here, Susan. So I use my sister as an example. Let's say she takes one of her credit cards and she's got 2 kids in college now. One who's actually playing baseball at Angelo State. So let's say she decides to put, one of her kids in college on a credit card. And even though, their son or daughter doesn't have any other credit history, they could have a huge instant credit score. Because now all of a sudden they're going to inherit all of that credit history, because they're being put on there as an authorized user, and that authorized user will report to the credit bureaus, and you inherit everything just as if it was yours. Okay. A great story I like to tell is I had a couple down in Cibolo. They were like on their 3rd marriage or something, and she had like great credit, and his credit was horrible. But she was like in the 8s, and she had like all these credit cards, all of them were paid off, and they're all opened up like in the 70s. And so she added, and I said, like, let's get him added to a couple of these credit cards, and he did. He got 90 points in 3 weeks by getting added to 2 cards. And he still had a lot of negative stuff on his credit report, but he actually qualified just on that alone.
Wow.
So it can be powerful to do that. But even if you just have, like, go back to the scenario where, you don't have any credit cards, but maybe the wife has one, maybe it's only 2 years old, and the husband doesn't have any, just doing that alone can give the husband a lot of points on their credit card, or vice versa. It doesn't necessarily have to be some long, credit card. It could be the fact that you don't have one, and now you have one, instantly reporting on your credit report. And guess what? There's no inquiry, there's no, you don't have to worry about length of credit history, all that kind of stuff. But it could also be that, in some cases, well, maybe the husband does have credit cards, but adding him to one of the wife's oldest credit cards could help, and that could help raise the score. So all of those kind of scenarios come into play with length of credit history.
In that scenario, could that hurt the wife by adding
No.
more?
So anything that's negative, like in that scenario with the husband and wife, the wife had the great credit scores, and he had like, he looked at his credit report, he didn't look like he'd like to pay a bill at all, okay? He had so many collections on his credit report, but none of those collections cross-reported onto hers, okay? So let's move on. Let's talk about the last 2 sections here that are 10% of your score each, types of credit used and new credit, okay? Types of credit used, this kind of goes to your question about what type of, the type of credit matters really as far as how it scores on there, but not to the point where you have to like get overwhelmed about making these decisions. But if you have too many stored cards, you can get hurt. Okay, a great example as I had a customer up in Dallas, and she had like 25 stored credit cards on her credit report. Okay, and I kidded with her. I was like, "You live near the Galleria?" And she's like, "Yeah, how'd you know?" I'm like, "You like to go there a lot because you got every credit card in the Galleria." So, yeah. But she made all her payments on time, but she actually looked, and when a mortgage person pulls a credit report, they actually give reasons why your credit score isn't perfect. And I think some sites are doing that now where they're showing you the reasons why something is not a perfect credit score. So, and one of those reasons could be too many open retail accounts, going back to what we said. But now, do you need to worry about going and opening up that Kohl's credit card? Well, no, they have great coupons, and you get Kohl's cash, right? So go open up the Kohl's card if you don't have one.
Should you use it if you don't use it? Like I've got a Sears card for Craftsman tools.
Yeah.
I maybe buy something every 5 years.
Yeah,
Does that hurt me if I'm not using it every
Except
month?
for Craftsman. No, but Sears is one of those. They won't close your credit line down. Macy's is another one. Some of them will if you don't use it. They'll close down your line of credit. Macy's is actually an example I use a lot of time when I talk about length of credit history, because I've seen it where a client will have a Macy's card, it hasn't been used in like 6 years, and when you stop using an account, the creditor may not close it and they may keep it open, but the date of last activity, okay, determines how much something weighs on your credit score, both positively and negatively, okay? But on the positive side, that means if you haven't used it in a long time, go back to that scenario where it was earning you 100 points. Well, now because you haven't used it in a long time, now maybe it's only earning you 20 points. You haven't really done anything. All you've done is just not use it. Okay? But in this scenario, and this is a real life scenario that I've told clients, go use that card. And boom, their credit score goes up. I had a client, he was an authorized user on his parents' BP gas card that hadn't been used in like 6 years. And the gas card itself was older than him. It really wasn't helping his credit score because it hadn't been used in so long. But the parents didn't want to use it. They're like, well, we don't believe in using credit cards. I'm like, take your parents out to a steak dinner and say, can I just put $5 of gas in my car on that gas card? And of course it did. They did. It worked. And he got like 35 points just by doing that. Just by charging something on a credit card that hadn't been used in a long time. Because of the date of last activity, but also because they kept it open and there was some potential. There was some potential there.
So I need to buy a tool.
Yeah, you haven't used it in a long time. And that's why we always say, show the activity. Yes. I mean, I'm sure you probably got every tool. Yeah. You're going to need a table saw. You need a new blade if you got a table saw,
Question back here.
Oh.
Not just really quickly.
Yeah.
Yes.
So when you say you want to use your credit card, how often should you be using it?
I mean, typically speaking, every month. But if it's a store card, I'm not saying like, oh yeah, you have to go to Macy's and buy something every month. But if you use it like a few times a year on like a store card, that's fine. But like your major credit cards, like if you have a Capital One card, that's why I say like take a monthly subscription like a Netflix or Sirius or Spotify or something like that. Throw it on there to where it just automatically charges and then you just pay that off. That's usually the best scenario for those type of cards. But for store cards, I mean, you're not going to walk in there, every month and buy something. Now, of course, when I talk to the women, they're like, "Oh yeah, tell me to go buy something." I actually did tell. There's another kind of cute story that I talked to this gentleman. He had a Justice card on there. He hadn't used it in a while, and his little girl was in the back, and she's like, "Are you telling me I need to go buy my little girl something from Justice?" And you can hear in the background, "Yay!" But it's just if you use those store cards every once in a while, that's fine, but you don't have to use it, all the time. But other things here and types of credit used, we asked the questions like how many credit cards should you have? 2 to 3. That also gets calculated in here. So we actually like to see a good mix between revolving and installment. So if you ask me out of the perfect world, if you're starting from scratch, well yeah, go get 3 credit cards and open up 1 installment loan. But again, if you've got 3 credit cards and you've got an average credit history of 25 years, I'm not saying you need to go get an installment loan, okay? It's not going to give you so many points that it makes a difference. But if you're building from scratch or if you don't have a lot of credit history and you still need to build something, well then sometimes I'll say, yeah, let's maybe look at getting you like an installment loan. Now, banks will actually tell you that what are called credit builder loans. Have you ever heard those terms before? So a credit builder loan is when you go and you open up like a CD for $1,000 and you borrow back against it, and they call it a credit builder loan. Well, they're in the job of selling you accounts, okay? And actually when I gave this presentation to the mortgage department at a credit union, and the president sat in and he freaked out when I talked about this. He's like, I was like, credit builder loans can actually hurt your credit. And he was like, what are you talking about? He's like, and so I explained to him why. He's like, oh my gosh, Chris, because we tell clients all the time, doesn't matter what your credit's like, if you open up a credit builder loan, your score will go up. Chase got sued for that, for doing that. So now banks do not tell their clients that anymore, okay, because it's not the fact. It's not a fact. Credit builder loans are great if you're starting from scratch or if you just don't really have any credit. But if you've got credit established, doing a credit builder loan could actually hurt you, okay? So you don't necessarily have to have an installment account. It's not as important as a revolving account, honestly, but it can help you. Now, other types of loan can help boost your score here, like a mortgage loan is gonna score higher than like a payday loan from Speedy Cash or whatever, right? So they do weigh those differently.
Does PayPal affect your account at all?
Not unless you open up a PayPal credit card.
Okay.
Yeah. So let's talk about the next section, the next 10% are here, new credit, okay? This has to do with opening up new accounts and inquiries, okay? So again, remember we talked about opening up a new account can be bad because it affects your length of credit history. Well, guess what? It can also give you a negative hit right away. Anytime you open up a new account, your score could drop up to 40 points just by opening up the new account, okay? The reason for that, in this section here, they're calculating the fact that most defaults actually happen in the first 90 days of any loan, period, any loan. Default happens in the first 90 days. So they calculate in there as a negative because you opened up a new account, okay? But it also means you get those points back, okay? You'll get those points back. It could take 3 to 4 months to fully get them back. So you don't have to worry that your score dropped initially, but you get them back eventually, okay? Now the other thing that impacts you here is an inquiry, okay? I'm sure everybody here has heard the term inquiry before. Everybody knows that they're bad. Anybody here think an inquiry is good? Okay, good. Yeah, inquiries are bad, but they're necessary evils, I mean, sometimes if you've got to buy a home, you've got to have somebody pull your credit report. Now, an inquiry is going to impact your score about 3 to 5 points on average, okay? And so it's not a lot. Now, obviously, if you have it pulled like 10 times, that could be a lot, okay? Now, there is something that's called a shopping window. So that means the more pulls you have within a specific length of time, all of those will count as one, theoretically, okay? But here's where the problem could come in. And this happens a lot in car dealerships, not so much in the mortgage industry, where they go and I actually talked to a guy yesterday. He taught me a new term. I was using the term shotgunning. They don't use that anymore. I guess that's kind of the 80s term. Now it's called blast and cast. So they blast and cast that information out there to help you get the best rate. That means they could, like the example I use is I had a client, he had his credit pulled 14 times to buy one car, okay? But he was told, hey, there's a shopping window, no big deal. It's all those 14, they'll just count as one. But his score dropped 35 points and he was about to close on a home. And he couldn't close on the home because of that. And there's a loan officer that brought this to me. I remember it was one of my loan officers in San Antonio. He was like, Chris, tell me why the score dropped 35 points. Now, not all credit reports will tell you this, but it did. It showed me the type of pull on there. And when you looked at it, of those 14, 4 of them showed up as auto. Okay, so that means those 4 that were auto pulls count as 1. The other 10 showed up as what are called financial, which there's no shopping window for financial. So financial is a credit card, a loan, so if you go and apply for 10 loans at 10 different banks, that's probably bad, right? It means you're looking for money because you got to pay your rent or mortgage, right? So they deem that as bad, so they're not going to give you a shopping window for financial. So in this case with this gentleman, he had basically 11 inquiries against him because he bought 1 car, and his score dropped 35 points as a result. Okay. Now, so those are the things to keep in mind. But like I said, it doesn't really happen that much in the mortgage industry, so you're usually pretty safe with shopping windows. But you really should just have Debbie pull it and James pull it and nobody else.
Is there anything to do about that? Because, I mean, that was reported incorrectly.
You're exactly right. And you know what? Every single person asks that question, and I want them to ask that question, so thank you. But no, you're right. It is wrong, and it is a mistake. It is reporting incorrectly, and this is a good example of how things can get reported inaccurately to the credit bureaus on something that is factual. Because it was factual. 14 items were pulled on his credit report, okay? And he signed off on those 14 items, okay? He legally signed off on them, but they're reporting inaccurately, okay? So inaccuracies can happen all the time on your credit report without you even knowing about it on things that are legitimately yours, okay? So let's talk about...
Chris, real quick, I just want to say to like be super careful with who you're working with and who you're letting you pull your credit, because I just started working with someone who was working with a different lender previous to us, and that lender was hitting their credit a hard pull once every 30 days just to see if their credit was changing.
I've heard that.
And it was actually damaging them.
Yeah.
So it's negligent, and also maybe irresponsible, but just be really careful about who you're working with.
I'm glad you brought that up, because that is something I like to talk about in inquiries. Do you guys know what the difference between a soft inquiry is and a hard inquiry?
I've
Okay.
heard of the soft inquiry through my credit union.
Okay, so a hard inquiry is when you apply for money or credit. Okay, so you're buying a home, you're buying a car, you're trying to get a loan of money. That's a hard inquiry. A soft inquiry is what's called a review pull. So any of your current creditors that are, if they want to review your credit, they can do that, and it's called a soft pull. Also, whenever we talked about credit monitoring before, those are all soft pulls. Okay. Now, all of our clients, when they sign up with us, we have them sign up with credit monitoring. Now, we know that those scores are not going to be the same ones that Debbie pulls. We know that. We talked about that. But it actually allows us to pull a new credit report every 30 days or so without having to go through the scenario that Debbie just talked about.
So
There's
really
no
pull
negative
a
impact to the
hard
score.
pull once every 90 days.
Yeah, and I've actually heard loan officers do that. They just sit there and they just pull it every 30 days, sometimes without actually really even asking the client again about it, and that hurts the credit score as a result. But in like what we do with our clients is we pull the credit report every 30 days, but it's a soft pull, and it shows us increasing credit scores, the activity, good, bad, or otherwise, on the credit report. So.
Little caveat there, insurance does rate on credit, and it's a soft pull too, so you don't have to worry about only quoting through one carrier.
Yeah, I've seen that. But here's on hard inquiries. But if you go get a new phone like Verizon, T-Mobile, Sprint, it's a hard pull. Okay. I still remember we had to close on our home, and we had Verizon. I had Verizon, and my wife was on my account, but we wanted to switch things over. She gets a discount because she's a teacher. So all we did was just switch over from my name to her name, but there was an inquiry, and it was right before we closed. It didn't keep us from getting in the home loan, but we still had to write like some letter of explanation, what's called an LOE. Because of it, I was like, okay, whatever. I just had to roll my eyes because it's so ridiculous. I'm like, it's Verizon, okay? But I had to write a letter of explanation saying that I did not take out a loan with Verizon. I'm like, unless I check, they're not a bank. But yeah, the Dish, all of those, can pull credit.
What's their justification for hurting your credit score if you had excellent credit and they're just checking it?
Yeah,
Why do they hurt you?
It's one of those funny things. I don't have a complete answer for it because on the other side is Verizon does not report that data to the credit report, to the credit bureaus every time you make a monthly payment on time or not on time. Now, the only time they report is when it's bad, an inquiry, or if it's a collection. That's the only time Verizon reports, or Sprint, or whoever.
But I mean, when these other places call, if you're looking around and say, well, I'm going to see about buying a home, I'm going to check different mortgage companies. If each of them hits you and you had excellent credit before and it's hurting you every time, just to say, this guy's got good credit, let's hurt him.
Well, that's what I'm talking about with the shopping window. So if you are shopping, you have a 45-day window, that multiple pulls, and I said in the mortgage industry, usually don't have those problems because they do get coded correctly most of the time. So that said, if you did pull your credit 5 times in a 45-day period, then it would only count as one pull. So.
Unless it's
coded incorrectly. Yeah. So let's go back to let's talk about errors and things like that can happen on their credit report. So that's just an example. We'll kind of talk more about those type of examples here in a second. But let's just talk about errors and negative items and start talking about that. How am I doing with time?
7 o'clock.
It's 7 o'clock?
About 30 minutes.
Okay, perfect. I can talk for the next 5 hours if you guys want. No? Okay.
It can get hard to stop.
So the FCC did a study, and they found that 7 out of 10 credit reports have some sort of detrimental error. The FCC is a regulating body of the government. So they've done the research. I mean, 70% of all credit reports have some kind of error on there. Now, the most glaring error on credit reports is identity-related errors. Okay, identity theft, identity errors. These are all kind of lumped in the same basket, but they are different. So let's talk about identity theft real quick. So identity theft is when someone steals your identity for financial gain. Anybody ever have their identity stolen here? Yeah. Okay. It can be a hard thing to go through. Actually helped one of my clients kind of go through the longer process of you know, a true identity theft after some of the first efforts weren't really working. And it can be hard to get those things off of there. Let's talk about real quick the different types of identity theft. Mail theft, dumpster diving, pretexting, shoulder surfing, phishing. Mail theft is basically when someone steals your mail. But a lot of times, you know, people have, you know, mailbox keys in the mailbox in their neighborhood. But like, you know, where my mom lives in Sun City, they don't. You know, everything's, you know, the old style mailbox. So it can be easy for people to steal your mail. But in Sun City, you don't worry about people. I mean, you get your mail 30 seconds after the mail person delivers it, right? That's a joke, my sister. But basically what they're looking for is they're looking for personal information. They're not necessarily looking for checks and things like that. They're literally just looking for personal information. And a lot of times all they're trying to do is just sell it on the dark web and make a little bit of money. Dumpster diving is kind of the same type of thing, but this time they're actually digging around in trash to get this information. So for that reason, it's always very important to shred all of your personal documents, things like that, to make sure that that doesn't happen. Pretexting. So this is not something you do before you text somebody. This is actually kind of like a con game, you know, grift type of thing. Some of the people that are, what was that movie I'm trying to think of with Jackie Gleason in it about the big con game. Anyways, I'll have to do some research and put that in my presentation. But it's like a hustle, you know, someone's trying to find out information from you and use that against you. So maybe they've looked over your shoulder or whatever, or maybe they've gotten some information. So if they know a little bit about, like, hey, they call you up and say, hey, I know you love tools and you love craftsman tools and whatever, and you're like, wow, this person really kind of knows me a little bit. And then they use that to get more information out of you, okay? And that's got to be careful when you talk on the phone with somebody that you don't know. They're going to, even if they feel like they do know you, you still got to ask all those questions, and that's what pretexting is. Shoulder surfing is basically looking over somebody's shoulder and stealing that information. PIN numbers, so make sure you protect those when you go to the grocery store. Phishing, not a big sport here in Texas. It's really about getting information from your email. So, and actually this just happened to me last week where I was on Twitter and I clicked on something. It was like, it said something weird. It said like, oh, your content, you know, your settings are not accurate on Twitter. That's why you can't read this feed. So you need to go to change your Twitter feed, you know, settings. So here, log in here. And I was like, wait a second. It was a phishing scam is what it was. They were just trying to get my username and password for Twitter. And it's the same thing with email. So if you put in information, if you think it looks like Gmail and you put in that username and password and it is a phishing attempt, now they've got all of your information, okay? And they've got all of your emails. And now they can blast those same types of emails out to everybody that's in your inbox. And then they get that email. They think it's a legitimate thing from Gmail and they open it up and they put in the username and password. So it's really good to use like two-step verification for that reason. And that, you know, so if somebody does open something up that's not a trusted computer, you'll get a message or a text about it. So, other types of things that aren't listed on here, like breaches, which you probably heard about with Equifax, and then also skimmers. So a skimmer is kind of a way to steal your actual credit card number and use that. And I've heard stories a lot of here in Austin and San Antonio, this area, this part of Texas, where that's happened a lot, where those gas station skimmers are on there. So just be careful when you go to a gas station. Shake it, make sure it looks like, you know, if there's like a little green light, I think HEB's got a little green light on there with a lock, and if that's not lit up green, probably should go inside and pay. So, now, but believe it or not, identity errors are actually more common than identity theft. And a lot of times when people have errors on their credit report, they think it's identity theft, even though it's not. It's actually just identity errors, okay? So that means same last name, same zip code. So Johnson, Smith, you know, Gonzalez, Lopez, Jones. If you have a name like that, a lot of times you're gonna have things on your credit report that don't belong to you. I remember a client of mine out in East Texas, his name was Joe Jones, and he had like 4 tax liens on his credit report. He was like, they weren't his. They legitimately weren't his. I was able to help them get them removed, but it's just because he had a common name those kind of things we're reporting on there inaccurately. Okay. And the other one here is also juniors and seniors is also very common. So, you know, John Smith Jr., John Smith Sr. can have those things, you know, cross-reporting on their credit report. Now, if 4 letters of your name match with 7 out of the 9 social security numbers, then your files can merge. Now, what that means is if you have probably a common first name is really usually where it really happens. So the example I always use is a guy by the name of Roberto. His file merged with a guy by the name of Robert, and only one security number was different. Okay, but he had things on there that weren't his. Some of them were positive, some of them were negative actually, but it can cause your score to drop as a result. Okay.
Hey Chris, I just want to say that we do see that being really common where people have things on their credit report that aren't theirs, or there might be things they didn't know about, like small collection items. So we try to make it a practice to go through all the liabilities with people when they apply, and when they apply with us, we'll give them a copy of their consumer credit report so that they can just double check everything. But we do see that very common.
Very common, yeah, yeah. But a lot of times what people think is automatically when they see things on there that aren't theirs, it's like, someone stole my identity, but that's not always the case. Okay. Now let's talk about just negative items in general. Now this kind of goes to, we'll talk more about like that inquiry and how that happened and how it can be fixed. So the types of negative items that can be on the credit report: collections, bankruptcies. BK is bankruptcy related items. So even if you go through a bankruptcy, all of those items that are related to the bankruptcy can also be negative as well. Charge off, profit and loss inquiries, tax liens, fraud, foreclosures, repossessions, lates, all of these things are negative items that are on your credit report, but they also can have things on there that are not reporting accurately, okay? Like what we just talked about. We use the example of the inquiry, which is why I tell that story, so you can understand that even though, like, well, yeah, but that medical collection was mine, but it may not be reporting accurately to the credit bureaus.
So you keep, you can separate that out. The names.
Yeah, so what we do when we're fixing someone's credit report on the negative side is we're opening up investigations on those negative items, okay? We're asking specific questions, things we know the creditors are supposed to keep on file, but a lot of times they don't, or it could be just things like, you know, that we know are inaccurate, like with inquiries. They have, once we open up an investigation, they have 30 to 45 days to respond. If they can't respond with that information within that time frame, then by law, it must be removed from the credit report. And the key is we do this every round, okay? And each time we're asking you questions and taking new tactics until we can find something they can't verify, and then the item comes off their credit report, okay? And a lot of times we're finding these inaccuracies that a lot of times they happen all the time, okay? And a lot of times people will have identity-related errors. Well, we can find those inaccuracies and a lot of times get those, you know, cleaned up as well, okay? But first, whenever we're looking at a credit report, we go through, we do an evaluation, we make sure there's everything right. You know, what can be done, can we help, things like that. And then we go through our process where we talk about how we actually can get the negative stuff, you know, fixed and stuff like that on your credit report. And then finally, elevating the scores. Any questions about that? Now, to get, I guess, into a little more detail about the process is sometimes people will try to do things on their own at this point, where they say, okay, I'm going to try to raise my credit score. And when people say, I'm going to do this on my own, what that means is I'm going to go pay off all my old collections, okay? So let me talk about that real quick. Now, how many people here think when you pay off a collection, it comes off your credit report? Does it? Yeah, it does not. And it's very common, and even when I talk to people like, Chris, I only have 2 things negative on my credit report, and when I pull it up, and they say, and I look, have I talked to you before? No. And then when you look and say, well, actually you have 10 negative items on your credit report. Oh, yeah, but it's just those 2 collections. I'm like, I paid off everything else. I'm like, yeah, but those collections that are paid off still negatively impact your credit score. Okay. The reason why it's because it's trying to show a history and a pattern. That's why they continually, impact your score. But here's the other thing too, is paying off a collection. Could it hurt your credit score?
Yeah.
Yeah, it can. I know, she's looking at it, what? Yeah, no, it can. So I actually have a story. It's a sad story, but I have a lot of stories, I know. But there was a single mom down in San Antonio, and she had 3 girls. She's trying to get her life back together after a messy divorce. And then she had the home of her dreams picked out. Everything was good. 3 weeks away from closing, some collection agency calls her up for a medical that was older and said, they won't let you close on that house with that medical on there. You're not going to be able to close on that home unless you pay this medical collection off. And by the way, we're going to help you out. We'll settle it right now. You can only pay us $400 for the $800 medical. She's like, oh, yeah, I got to get the home. So yeah, I'll pay it off. Did the collection agency tell the truth?
No.
No. It's a total lie, right? You can still close a home with a medical collection on there. It's, they don't care about medical collections. It still impacts the credit score, but they don't care. So it was a total lie. Got the client, she paid it off, and then what happened is it renewed the activity, so they had to re-pull credit right before closing. Her scores dropped 50 points. She lost the home.
Because of that?
Because of that.
Oh my God.
Yeah. So you just got to be careful. I'm not saying don't pay collections. You just got to be careful. That's a big part of our.
Ask your lender.
Ask your
before
lender.
you do it.
Exactly.
And I'm going to say that's Chris.
Yeah. Yeah. And a lot of times it's going to come back to me. So we usually put together a plan with our clients on what makes sense to pay and not pay and things like that. So.
I always just tell people it's like navigating a minefield. If you don't know if something's going to blow up or not, just don't do it alone. Get an expert to make sure that what you're doing is the right thing to do.
Yeah.
And backfire on you.
Yeah, for sure.
So does she have to start her process all over again?
That client? Well, basically, no, she signed it with me. I got the medical collection removed. Her scores went back up, and she found another home. So there's a happy ending.
You can take them off then.
Mm-hmm. Yeah.
Oh.
Yeah. Yeah. Any questions? Let me just kind of open this up. I know we've got about 10 more minutes here. So any questions, any and all questions?
Is there a fee for your service?
Yeah, that was my question.
So we do have a fee for our service. You can stop it now.
Maybe we can make it a non-profit someday.
But yeah, so basically the